You all both in the room and listening on the web for joining us here at the New America Foundation as we try to figure out how to regulate to avoid the next financial crisis. I'm Ellen Seidman. I'm the Director of Financial Services Policy in the Asset Building Program here at New America. When we first started talking to the authors about this paper about 15 months ago, we knew it would be an important paper. But what we didn't really realize was quite how timely it would be. We're very glad it took them 15 months to get it together. A recent Pew survey tells us how hard the current crisis is hitting the American consumer. People are reining in spending, and for the first time, a majority say people should learn to live with less. We're not here today to debate how we got into this situation. But I firmly believe that one reason is that the regulatory system through which we help consumers decide what financial products and services to buy and whether to save is broken. Today we'll hear about an alternative paradigm, one for regulation, one based on the learnings of behavioral economics and industrial organization. This is the beginning of an important and timely dialogue. I urge you to participate both with us today and to read the paper, which you have on your seats if you're here, but which is also available on the web. So now let me introduce our moderator, David Wessel, our authors, Michael Barr and Eldar Shafir, and our discussants, Alex Pollack and Travis Plunkett, and I thank them all very much. I think this is going to be an extremely lively conversation. David Wessel is the D.C. Bureau Chief of the Wall Street Journal and writes the Capital column. He also appears frequently on CNBC and National Public Radio. Among other honors, David has won 2 Pulitzer Prizes, including one in 2002 for stories in the Journal about corporate wrongdoing. One wonders whether there's another one on the way. Michael Barr is a professor of law at the University of Michigan Law School and senior fellow at the Center for American Progress and the Brookings Institution. Michael served in a number of senior positions in the Treasury Department in the Clinton administration and has done extensive research and writing on how lower-income Americans use financial services and how to improve both the services and the outcomes. Eldar Shafir is professor of psychology and public affairs at the Department of Psychology and the Woodrow Wilson School of Public and International Affairs at Princeton. Eldar's research focuses on experimental studies of decision-making in situations of conflict and uncertainty, and he's recently done a good deal of work on financial services. Alex Pollack is resident fellow at the American Enterprise Institute, focusing on financial policy issues. Alex has a long history in banking, including 12 years as president and CEO of the Federal Home Loan Bank of Chicago. Travis Plunkett is legislative director at the Consumer Federation of America. He's a leading consumer advocate in the field of financial services with a special focus on credit cards. Thank you all for being here, and thanks to the panel, and I'll turn it over to David. Thank you.
Thank you very much. It's a pleasure to be here. It seems to me that this is particularly timely because there's consensus on very little in Washington at the moment, but I think there's consensus that we didn't have the optimal regulation leading up to this event. And I think that while talking about a different kind of financial regulation has been a perennial topic in Washington for decades, that what's happened in the last 6 months has forced Congress's hand and the next administration's hand. And there is no doubt that the regulatory apparatus will be reopened and each piece will be examined in new light. And I think the value of this discussion we're going to have today is it would be nice if we could do something better than just tweak the existing dials. Whenever we do that, we either turn some too much or some too little, and instead try and take advantage of all the progress that's been made in academia over the last decade and thinking about kind of a new way to regulate that both takes advantage of the fact that there is some virtue in giving consumers choice, but also builds on the notion that people don't make choices in a vacuum. Dick Thaler of the University of Chicago, who's one of the godfathers of this research, tells a wonderful story about what would happen if the average school cafeteria had 12 feet of desserts and 1 feet of vegetables. What do you think the kids would eat? The order in which you present choices to consumers really matters. So our order of the program today is Eldar and Michael are going to each speak. They tell me for 11 minutes each, which leads me to believe they've done this before. And then Alex and Travis will respond for 7 minutes each, and that'll still give us time for questions. So, Eldar?
Thank you. It's a pleasure, and thank you to the New America Foundation for having us write and present. Last time we did this, actually, Michael did both sides, both of us, because I was unavailable. So today we'll see how we do when we're both here. What we thought we'd do is, since this is really an attempt to give a behavioral view onto policy and regulation, is I would give you a 10 or 11 minutes overview of sort of Psycho 101, where the behavioral work comes from, what we've learned, and how it might impinge on policy and on regulation, and then Michael will give you an overview of how we attempt to apply that in the present context. So, Psych 101, I think the milieu of all this discussion is really a tension between two alternative views of the human agent. The original view, the one that predominates policy schools, business schools, and the one that guides most thinking in Washington, is something close to a rational agent model. People are assumed to know their preferences, to have pretty consistent preferences, and given a well-functioning market, to do a pretty good job of maximizing what they want in light of the opportunities they have available. And if you have that view, lurking policy implications is that they need no help from anybody. Give them a rich market and let them do the best they can. They need very little help or protection. The alternative view in this discussion is the one that comes from empirical and experimental research. Sometimes it's intuitive, sometimes less. I'll try to give you a couple of non-intuitive examples that finds that people, in fact, are quite different from the original assumptions. They have very mediocre judgment that's guided by heuristics and shortcuts that might systematically mislead. They're impulsive, myopic, and all that kind of stuff. They're often inconsistent, ineffective, and they could really use some attention and some help. So, the paternalistic flavor lurks in the background, and that's the discussion. So I want to give you 4 minutes of studies that show how people are highly context dependent. Their preferences are highly malleable. Small nuances that ought not to matter make a difference in what people do, which comes to play a major role in how we are trying to think about regulation now in light of current events. A lot of pictures are missing, I apologize. That's a bad transfer from the Mac. So here's a simple question. You ask people to estimate the number of hours they watch television a week. And notice relative to having to estimate recessions and wars, this is a very, very easy judgment. You all know it better than anybody else. And you can ask this question, or you can ask the following question. Please estimate the average number of hours you watch television a week. Happens to be the identical question. We've just changed a bit the scales. And what you discover is the average American watches 10 in the first case and 6 hours in the second. Now, of course, if your agenda is to report that Americans watch more TV rather than less, you should ask the first question rather than the second. More interesting from our perspective is, how do you ask this question context-free? How do I get your real estimate? Turns out it's very hard to do. Even if I give you no scale and ask you to suggest a number, it turns out that the numbers you saw a minute ago might impinge on that judgment. If I have you write the last 3 digits of your social security number in the corner, that will have an impact on your estimate, etc. So this is hard to do context-free. Jumping to things that are more relevant, people feel conflict when they make decisions. In the standard analysis, you can feel conflict. It doesn't matter. At the end of the day, you'll maximize your utilities. The more options I give you, the better it is. The more likely you are to find the one that satisfies your utility function. What we find instead is that people, when they have too many alternatives, might retract, might defer decisions, might find it hard to make a choice. So in this very classic study, they go to one of those supermarkets that offer 300 types of mustard, and they put on display for people to taste, randomized in different days, either 6 or 24 different jams. And what you find is in the days when you have 24 jams, more people stop, but nobody buys. And so the idea is, if you give me 6, I know I don't like strawberry, I taste 2, and I kind of feel like I know how to make the right decision. When you give me 24, I just don't know how to make the right choice, and I say, I'll buy it another day. This, of course, goes contrary to what we teach in marketing and in business schools, where if you're going to open a shop, the more selection, the better. And it has implications. So, for example, a recent study that analyzes 401k options, which, as you all know, went from roughly 3 to 3,000 in a few years, estimates that for every 10 options that you add to the available set, take-up of any of them goes down 2%. So this is a real welfare implications for the idea that we enrich the choice. We've done some work in Medicare Part D. Those of you who are interested in Medicare Part D, it's an interesting case where the government is proud to throw at the elderly in Florida 43 different alternatives that differ on 40 dimensions, and it creates a mess because they don't know how to choose, and it goes contrary to some very simple assumption about optimization and maximization that guides a lot of the thinking. This is to tell you, this is not just that some people are misguided and some are not, some are confused, some are not. There is some of that. The elderly, for example, are sometimes more prone to these issues than the young, so Medicare Part D, that becomes a dramatic implication. But this is a nice case where you do a simple prisoner's dilemma game. It's a silly game that's supposed to gauge how cooperative or competitive you are. And you basically, you present the exact same game, but you call it either the community game or the Wall Street game. And furthermore, you take subjects whose roommates at Stanford judge them to be particularly cooperative or particularly competitive. And what you find is that whether you are judged by your friends to be cooperative or competitive makes no difference, but the name of the game, which is supposed to gauge your competitiveness as a human, changes from 70 to 30% cooperation by just renaming the game. And so that's to say, again, how competitive am I? Well, you know, small nuances in how you call things trigger very different behaviors with real implications. I knew this was not going to come out. I really apologize. This is a table that summarizes the rates of organ donors in different European nations. It got a lot of press in recent years. So if you look at the organ donation rates of different European countries among drivers, about 6 or 7 countries average 94% among drivers, and the others 4 or 5 average 14%. You ask what's the difference? You have Austria on one side, Germany on the other, Belgium, Netherlands, what's the difference? Some countries are opt-out. You are a donor unless you choose not to be. The others are opt-in. You are not a donor unless you choose to be. That difference, now the transaction cost in most of these cases is signing the back of your driver's license, pretty easy. It's, you know, it's not jams, it's what your family does with your body. Nonetheless, just changing from opt-in to opt-out changes your nation from one where everybody is a donor to one where hardly anybody is, with obvious implications for when one of our family needs an organ. So that's another example of simple defaults that make an enormous difference in ways that appear irrelevant from a rational, more standard perspective. And this is a personal anecdote I tell. I once heard a lecture on local optimization in computer science and realized that for 3 years, as a graduate student, I was taking one route from home to school and a different route from school to home. This is a very ugly garage at MIT, and I realized that when I hit this garage, going right felt like it was going backwards, going left felt like it was going forward, so I took a left. When I came home at the end of the day, going right felt like it was going backwards, going left felt like it was going forward, so I took a left. And for 3 years, I was basically sub-optimizing by about 200 yards in one direction. Now, it's important, had it been 3 miles, I would have noticed, but as long as it's not terribly perceptible, I was doing something very reasonable locally. But globally, I was led to do something very different. And so part of our our message in thinking about regulation is people have their preferences, their attitudes. You tweak and nuance, and they end up going in different routes. This is an example of a context that's designed badly. These people have an intention to go spend an hour on the Stairmaster. You put the escalator, they take it. And that's a design flaw in a sense. More interestingly, social psychologists talk a lot about channel factors. These are ways of designing context, unlike this case, that are supposed to help people, that make you take the right path in some sense. So to give you one, again, I'm missing some pictures, sorry. To give you one example, we did a small project with the Center for Economic Progress and Shore Bank in Chicago, where the unbanked, well, among others, the unbanked come to get help with their taxes, and the Center for Economic Progress tries to convince them to open a bank account. Success rate is not bad. It approaches 50%. What we did in this case is after they get the tutorial and express an interest, half of them in the control condition, as always, are invited to go to Shore Bank and open an account. The others in the experimental condition have a bank representative available in situ, right there on location. They still have to end up going to the bank, so transaction cost is kept constant, but they can initiate the proceedings now, so that they won't forget, they won't defer, it begins now, and take-up goes significantly up. Now notice we haven't changed their attitudes, we haven't changed their trust of the bank, we haven't changed their belief in the message. Just having that channel factor, that escalator that helps them initiate the process leads to much greater success. There's a general phenomenon here that psychologists have studied quite a bit, and it's the breakdown between intention and action. Very often the probability of your behavior does not correlate very highly with your intention. Diet, exercise, self-education, self-exams, medically, these are all cases people know, they understand, they intend, and they don't do. And a lot of work has shown basically that manipulations that are designed to increase intention, for example, education, often have a very unwanted outcome, which is they lead you to misjudge. You tell me how important it is to eat healthy, I now predict myself more likely to eat healthy, and I fail. On the other hand, if you design the context in a way that helps, you redesign the cafeteria, forget my intention as long as I understand something about eating healthy. Now, instead of drilling me further, leading me to misgauge the chance I'll do things right, just redesign the cafeteria and I'll actually do things right without having altered my intention significantly. This is sort of a classic quote, where standard intuition would hold the primary cause of a problem to be human frailty or the particular weakness of a group or individuals. The social psychologist would often look into situational barriers and to ways to overcome them. A lot of the stuff that we will be talking about that Michael will present are cases where people fail, and the question is, do you blame them or do you try to design the context slightly differently? I think there's a very interesting paradoxical effect to me here. The rational agent perspective, the one supposed to laud us with being magnificently capable, blames us for our mistakes, whereas the more psychologically flawed humanistic perspectives forgives and says, let me help you do it better. I'm not sure which is more insulting to the human agent at the end of the day, when we say, look, you're failing because you're human, let us help you, as opposed to you're failing because you don't understand, you have the wrong values, you need to be educated, you're, inconsistent, etc. Once we accept human frailty, interesting things happen. For example, the fact that a program succeeds, is self-sustaining, needn't mean that it's in fact of social efficacy, that it's improving human welfare. You can think of check cashers, payday loans, even credit cards. There are cases where the success of it doesn't necessarily mean that it's improving the well-being of those who are using it, etc. And considerations of ethics and morality are altered thereby. So everything from long forms to fine print to the wrong defaults, things that we educate our students not to care about, end up having an enormous impact on welfare in ways that it might be unethical not to pay attention to. I'll end with a provocative example. When you take Psych 101 and look at some of the examples I haven't gone into here about Milgram's experiments and other cases where people do very bad things because of context, when you take those courses, you realize when you open the paper and read about Abu Ghraib, this is not about bad people, it's about very average people in a really bad context. To me, in some sense, we have created a financial Abu Ghraib for many American citizens, where basically they're very nice people, very regular folks, capable folks, and we throw them in a context that leads to failure in ways that are irresponsible if we understand the contextual impact on behavior. So that's the background from which we departed in attempting to propose regulations that would be more useful to those sorts of human agents.
So I want to pick up where Eldar left off. This is a joint project, I should say, with Sendel Mullainathan, who couldn't be here, but is very much part of this trio. And I want to thank New America and Ray Bouchard and Ellen Seidman for having us here to talk with you about this work. So Eldar was talking about some key insights from psychology that we tried to use to inform our work. And what I want to try and do is now embed that psychology in a marketplace for our discussion. So if you start on this side with basic human failings that are common, that we share, most of us have difficulty fully understanding how to compound interest and the importance of the compounding of interest in financial decision making. And that leads us to do two things. It leads us to undersave, and it leads us to overborrow. So in one context, consumers misunderstand compounding and savings. Banks, generally speaking, or if the financial system, generally speaking, would like to overcome that problem so that we save more and there are more funds to invest in the real economy. In the context of borrowing, it's not obvious that banks would like us to overcome this problem. Now, partly that's because of the particular incentive structure that we've had in our financial system for the last 15 years, in which in our mortgage system of our originate to distribute model of mortgage system, there's been not enough risk retained by the parties making the loan, so that the incentives between borrowers and lenders and brokers and others in the system are not well aligned. But even if we were to fix that problem going forward, we would suggest that the idea that we're going to live in a world in which there's no wedge between the incentives in our financial system of different actors is highly unlikely to persist, and new financial innovations will come in that will open up a new wedge in incentives facing different actors in our system going forward. So we need to think about how to set up a system that takes account of the fact that there will always be agency costs, there will always be a difference in incentives, and there may be continuing to be this market push against fixing or helping individuals in this failing with respect to overborrowing. In thinking about the tools that the regulator has available to address basic problems in the financial sector, we've massively oversimplified, for purposes of illustrating what we're trying to do, into thinking about the regulator as having two kinds of tools. A kind of tool of, in order to change the game, a kind of rule that changes rules, a kind of approach that changes rules, or a kind of approach that changes the scoring of the game. Instead of getting 7 points if you score a touchdown, you get 9, or you get -9 would be an example of changing the scoring. Changing the rules would be saying, obviously, that certain kind of activity that had been considered fair game before is now foul. So changing the rules of the game, changing the scoring. Two examples from the financial world, right? Or an example of a rule change might be moving to a system, as Eldar described, of opt-outs for retirement saving. You're in your retirement plan unless you opt out. The evidence suggests this significantly increases retirement savings. An example of a scoring change would be in the 401k context, the tax penalties we have in place if a 401k plan is so-called top-heavy, meaning it has in its composition too many highly paid workers in relation to other workers in the company. So that's an example of changing the scoring to influence retirement savings. In the 401k context, we have both those kind of rules because there are different incentives in each context. So just putting that context together and thinking about these two very different situations, one in which the market is working in favor of overcoming the human failing. That's on this side, the left side of your chart. And the other context in which firms might have an incentive to exploit the human failing, to continue to have you not process information in a way that lets you understand it, changes your intention leads to a proper action, which, as Eldar described, is quite a heroic assumption in any event. If the market is working in favor of the breakdown of that connection, you might need different kinds of rules. And so what I want to try and do today is describe some of the kinds of rules that rules and scoring changes that we might use in both kinds of contexts. And I'm going to start by focusing on the more difficult case, the more difficult case being when the market wants to continue to exploit the human failing. I want to do that to illustrate the difficulty of translating easily and without thought from the world of opt-out and retirement savings to the world of credit. So in the world of home mortgages, I don't want to dwell on this, but we've all seen the breakdown in this our basic understanding of how the mortgage system ought to work. Bad decision-making regarding complex products, misperception about the consequences of our action, misforecasting about the kind of payment behavior we're going to undertake as borrowers, information overload, not only from the product itself, but from disclosure about the product that lets us make quite bad decisions. And as I mentioned, the industrial organization of our home mortgage system is such that the incentives that were supposed to prevent bad borrowing from happening were absent. So what could we do about that? What I want to try and do is present one idea in this area in some more depth, and then a series of ideas rather quickly in the interest of time, and we're going to work our way through this. So one idea that we could pursue is what we're calling a sticky opt-out home mortgage system. Isn't that just a horrible expression? But here it is. there's an extra prize at the end for those of you who can rename each of our regulatory approaches in a catchier way. So what do I mean by an opt-out mortgage system, and why does it need to be sticky? An opt-out home mortgage system would work something like this. You go to apply for a home mortgage loan, and you are offered a range of competing products that share a characteristic. They are, for example, a 30-year fixed-rate mortgage with straightforward underwriting and clear terms. Or they are a series of longer-term ARM products with straightforward terms and clear underwriting. A basket of options from which to choose, but they're all comparable options, and they're options that for most people, most of the time, are both understandable and aligned with their interests. That's the mortgage that you would get unless you opted out. So we'd have an opt-out home mortgage system, and it's designed to have change the basic rules of the game so that fewer people make bad decisions that harm themselves. Why a sticky opt-out home mortgage system? Stickiness in this case means changing the scoring in addition to changing the rules, and changing the scoring in such a way that there are costs to the lender of encouraging you to opt out. Why do we need some kind of stickiness? Because if we're right that the market will always be pushing against our human failing and wanting us to overborrow or wanting us to make a bad decision in order to generate, say, higher fees or yield spread premium and the like, then we need some way of putting some pressure against the market. And you can do that in lots of different forms, but the basic idea of the stickiness approach is to say we understand that in this particular context, we're not on the left side of the chart where the market's working with us, we're on the right side of the chart where the market's working against us. We're going to leave the consumer choice in place, but we're going to have some stickiness to the opt-out so that the market is not seeking too strongly to overcome that. And there are all kinds of ways to do that. We can talk about them in the question and answer period. What will this do? Hopefully it will continue to permit financial innovation, but do it in a way that only works when the lender can clearly explain to the borrower the terms and risks of taking out that alternative product. So, for example, you could have in place, corresponding with this, a second idea that could operate with our sticky default or on its own, a different kind of truth in lending standard. What if you had an ex post determination of reasonableness? You had TILA to continue to have comparability, but there was an additional standards-based approach that asks, would the typical borrower understand the mortgage that they were being offered based on the disclosures that were provided? It would be a reasonableness standard equivalent to the kind of standard we apply in warranty cases in the sales context. So using an objective standard, a determination of whether the disclosure was a reasonable one that a reasonable borrower in this context would have understood. And again, the idea is, in this context, to try and shift some of the conversation from compliance with TILA, which in itself can be confusing and difficult for the borrower, and compliance with a long series of disclosure requirements which can lead to information overload, to a real assessment after the fact of was this reasonable. And in doing that, we also eliminate the kind of problems we've seen with respect to lenders getting around TILA by complying with it. Here's this piece of paper, this disclosure. Don't look at it. It's not worth it. It's not useful. Or developing products that are designed to comply with TILA, but whose costs are outside of the inclusion of the TILA rules. So it's a problem that's pervasive with rules. They're easy to evade. A standard might help in that context. A third idea is to use so-called information debiasing. This is the idea that we might change the way people think about a problem by reframing it for them, providing them with information that's salient to them, and have them make better decisions. This is, you'll notice, a much weaker version of than the two ideas I've said with respect to individuals, because now we're trying to change the intentionality of individuals. We're trying to do that in a behaviorally informed way. We're trying to do that not simply with the presentation of additional documentation about disclosures, but it is still a step removed from what I've just described with defaults. So one idea for that would be providing full information to the borrower about the true costs of their loan product. Another way of changing the scoring in the system is to change the incentive structure in the system. So, for example, you could do that by banning yield spread premiums, or more aggressively by changing the fundamental incentive structure between borrowers and brokers, imposing a fiduciary duty on mortgage brokers to borrowers. So instead of working for themselves, the mortgage broker would be working for the borrower. A huge change in our incentive structure system, but if we're going to have trusted advisors in our system, they should be trusted because they work for the borrower.
Explain what a yield spread premium is.
Oh, yes, I'm sorry. Yield spread premium is a way of making a payment from the lender to the broker. In principle, the yield spread premiums could be just designed to fulfill an important service function, a matchmaking function by the broker. In practice, really, in the last 15 years, they've increasingly become used to compensate brokers for getting borrowers to accept a mortgage that is higher cost, contains prepayment penalties, and other factors that drive up the cost to the borrower, increase the return to the lender, and therefore the broker gets paid more for putting the borrower into that product. So you could ban yield spread premiums and replace with a flat fee, particularly one based on performance later. You could move to fiduciary duties. What I think doesn't make sense in this context, although I used to think it made sense until I started reading some of Eldar's work, one idea I used to have was to say, the broker would carry a big sign that says, I work for myself, I don't work for you, I'm trying to get you in the worst loan possible. And I thought this would solve the problem, but then Eldar assured me that that would just increase the trust the borrower had in the broker, because after all, the broker was being honest. So they must be looking out for their best interest. So a couple ideas in the credit card area. I know I'm running short on time. One idea in the credit card area is to have an opt-out payment plan for credit cards. So one problem is that we're always putting off the decision to pay, or we're being encouraged by the disclosure on the credit card statements to make the minimum payment due. You all know the credit card industry fought tooth and nail against efforts to get the actual payment required to, the period of time required to pay off a balance on a credit card. So one idea is to actually have an opt-out system, so you have a reasonable rate of repayment built into the payment product every month. If you want to pay slower or you want to pay faster, you have to opt out, but the benchmark is this is the payment plan that you're going to make. It's not the minimum payment, it's the amount that would pay off your balance over a reasonably short period of time. So another strategy in this area. A stronger idea would be to have an opt-out credit card. So here's a credit card. Lenders can compete on rates, but the opt-out credit card is a clean credit card. Elizabeth Warren's been doing great work in this area. You have a clean credit card. That's the card everybody gets unless they opt out. Another idea is to regulate late and over limit fees. Again, this is a way of changing the scoring. A lot of credit card models of payment are based on high fee generation. One of those areas is in late and over credit limit fees. Lenders have a legitimate interest in preventing borrowers from paying late or going over the limit. So let them preserve that by charging people, but all the money goes into a government fund for consumer financial education. So the deterrent value is still there. The credit card companies get to deter bad conduct, but the money goes into a fund, and the idea there is you're changing the scoring. You're going to make it a lot less likely that fees will be focused on that, assuming the human failing that we all have. And then lastly, two ideas in the savings context. So we've moved from the right side of the screen to the left side of the screen, where we're talking about where the market would like to work together to overcome the human failing and procrastination in savings and under-saving. And the real problem with respect to this for low and moderate income households has been firms don't want to invest any money in products that serve low and moderate income people because there are high administrative costs in relation to low savings levels. So what do you need to do in that context? You change the scoring. You can do that in this example by a tax credit for offering low-cost accounts, debit card-based accounts to low-income households. Or you can change it by changing rules and scoring. So you could have the IRS have a direct deposit account for tax refunds. New America is doing really important work in this area, and you could really change the nature of product offerings both through these kind of opt-out requirements through the IRS and or through additional scoring changes through the tax code. So that was a whirlwind tour through 10 ideas designed to translate into real market context some of the insights from behavioral economics, understanding that the market context, the industrial organization of the particular sector you're working in should have a major impact on the shape of the rules or scoring decisions that you make as a regulator, as a policymaker. And I look forward very much to our conversation about them today.
Alex?
Can I do this just from here?
Why did you do it?
Thanks. Thanks very much to the New American Foundation, and especially to Ellen for inviting me here today. To begin with, I found this paper a very interesting read.
Excuse me, can everybody hear him in the back or not? Yeah? Okay.
Okay.
Hold the mic a little closer.
What I just said was I found this paper a very interesting read. And the key point that to understand certain patterns in human decision-making and apply it to the design of the way financial systems work, like other interesting ideas, once you think about it, seems obvious. In one sense, of course, it's a very old idea. The issue so interestingly discussed by Professor Shafir of framing of decisions and the way you describe decisions would, for example, have been well understood by the sophists of ancient Greece, say Protagoras, as they developed the idea of rhetoric, well understood by salesmen and by marketers. And when you come to the acceptance of human frailty, nobody knows more about human frailty than a moneylender, like me. I do have one quibble in the rhetoric of the paper itself, and that's the use of the term "the market," which in the paper is used to describe the suppliers to the market, whereas in fact the right meaning of the market is the interaction of the suppliers and the buyers. But if we think about taking this in a broader context, the notion of thinking about behavior and frailty and biases in decision making, thinking about it in a broader context, it is obviously very important in financial behavior, in broader things like the creation of financial bubbles and busts. For those of you who may want to go look at it on the AEI website, for example, there's a paper by me called The Human Foundations of Financial Risk, which explores these psychological or behavioral underpinnings of the creation of credit and asset bubbles and the subsequent bust like we're having now. Now, one of these human events is, of course, the propensity to gamble, a frailty so well exploited by state lotteries, for example. But I do want to pause a minute, because understanding these behavioral aspects seems to me an unmitigated good, but we don't want it to verge, as was suggested in Professor Shafir's opening comments, into a paternalistic state. At least I don't, let alone a maternalistic state, which is one stage further. It's my view that people should be able to take risks if they want to, both as borrowers and as lenders, but we do have a really interesting problem about how to make this risk-taking informed. You don't want people to take stupid risks. And this leads us to a set of very interesting problems with disclosure. In the investment area, for example, if you have a room full of well-to-do people who make investments, and ask them if they buy securities, and they say they do, and they say, do you get prospectuses of the SEC required disclosures, maybe 80 or 100 pages long, and they say yes. And you say, what do you do with them? And they say, throw it in the wastebasket. Likewise, if you ask people what they do with their charge card disclosures, terms and conditions, as Tim and I were discussing, they say the same thing. Throw it in the wastebasket. And a point often made about mortgage disclosures, in quotes, disclosures in quotes, is that there's a lot of stuff there, but it doesn't effectively convey any knowledge. And all this, as some of you know, led me to propose the Pollock one-page mortgage form as a way to try to concentrate what somebody really needs to know about a mortgage in one page, we hope, easily understandable and geared to incentives. And it seems to me that that proposal is entirely consistent with the approach suggested in this paper. There's also a little worry about how do we really know what's best. For example, on first blush, it seems obvious that you ought to get people to put more money into their retirement savings where it's locked up. That seems like a good. But then we get into tough times, like currently when people need cash, and then it turns out to be difficult to extract the savings from the 401k. And now you may end up borrowing, let's say, at 15 or 20% in order to finance current needs, while at the same time you've got funds locked up, let's say very conservatively, in a retirement account, earning 4 or 5%. So you got assets earning 4 or 5%, you're paying 15 or 20 to borrow. You are reducing your lifetime assets by having been, let's say, opted into your 401k. On yield spread premiums, which is obviously a contentious topic, it is my view that the best mortgage system would be one that had no points and no closing costs, and every loan was purely a no point, no cost, all rate. That would give you the easiest, most direct way. That's what I personally always insist on being quoted in mortgage markets, but you're going to have to pay some equivalent of yield spread premiums if you want a system like that. Now, outside of pensions mentioned a minute ago, the paper has, in my view, a very healthy emphasis on savings. And it discusses, among other things, pre-commitments. There's some really interesting examples of pre-commitments in savings, which we ought to study in this contract. The one, in this context, the one is the savings contract, old-fashioned savings and loans. I'm talking about 1910, 1920, 1930. You became a member of the association by entering into a savings contract. At one point in my checkered career, I ran a big savings and loan in St. Louis called Community Federal. Community Federal was formed in 1933 in a second-floor room over a bar in a blue-collar section of St. Louis. And I found one night, going through the archives, which I used to do for fun, the original page where the founders of the association formed the association by promising to save. And you had to sign $2 a week, $10 a week, $3 a week. This is an old idea, but it's very powerful, in my opinion. And note that it exists today in Germany in the form of the Bausparkassen, or the Bauspar building savings movement, which is what they call a contract savings, where you explicitly enter into a contract to save, and you earn your right to borrow on your mortgage by fulfilling the savings contract. I don't know if you've looked at that, but it's worth looking at. Interestingly, in these contexts, note that the behavior required to fulfill a regular savings contract is the same behavior required to pay regularly on your loan. So it's you're giving a behavioral evidence of your credit worthiness. Now, some other ideas triggered by this paper, in my mind, are thinking about ways to apply suitability in a clever way to consumer finances where it exists in securities. And by that I don't mean, which doesn't seem to me realistic, saying that purveyors have to always be fiduciaries for customers. But I wonder if you couldn't, let's say in a mortgage discussion, the same way you have to do with your broker in investing, categorize yourself by your level of expertise in mortgage finance. In other words, for me, who spent a few decades fooling around with these ideas, I don't want somebody telling me what loan I can have and not have. And I think I know a lot more about it than my friendly mortgage broker. But somebody might well categorize themselves as naive or beginner or novice class, and that might trigger certain kinds of presentations they'd have to get or protections they would have. A second one, the paper mentioned several times industrial organization. That triggered this idea in my mind. It doesn't discuss mutual organizations. Now, historically, one of the organizational responses to serving low-income people and relatively unsophisticated people was the mutual organization. I think we ought to revive interest in mutual organizations, in particular small local mutual organizations who would be maybe perfect purveyors of very simple, straightforward, no bells and whistles kinds of financial products. I have a good friend who runs the United Kingdom Building Societies Association, and they keep, of course, they're in the UK, to be a building society, you must be a mutual. If you convert to stock, you lose your building society charter. And they keep coming up with surveys showing that building societies treat their customers better, and there may be something to this idea. Finally, and this is my last point, is education. This came up, I think, in a skeptical way in Professor Shafir's comments. In Professor Barr's comments, he wants to have a government fund for consumer financial education, so you must believe in education, Michael. But perhaps some of these behavioral biases could be helped by practical education in financial matters in youth, about 11th grade, practical education, say, on how to get a mortgage. One of the ideas I have is you ought to have to take the Pollock one-page mortgage form and learn how to fill it out yourself about any mortgage, so that you can decide for yourself whether you can afford this mortgage.
This would be in contrast to giving everybody a credit card in 11th grade.
Right. Absolutely. Couldn't agree more. All of my children were propagandized from birth that if you do get a credit card, you pay it off every month, and they all do, I'm happy to say. You could be taught about the dangers of teaser rates, and you might even study compound interest and its effects. And I'm enough of a believer in education, although its limitations are clear, that some of these things might be improved by that. And thanks again for the ability to make these comments.
I'm going to suggest that everybody slide down about half a foot so that Travis doesn't feel like he's speaking to the pillar.
Emerging from my dark corner here. Okay, I'm going to crowd Alex here for a minute, and then I'll scoot back. Thank you to the New America Foundation and to Ellen for this invitation to participate on a panel with a number of very interesting and experienced people. I think this is a very thoughtful paper. The Consumer Federation of America is very excited about the insights, many of the insights in the paper regarding the relationship between behavioral psychology, behavior in the financial services marketplace, and regulation. In particular, we are excited about it in the savings context. As you will see in a minute, I think it presents challenges in some credit contexts. My experience over the last 10 years is in following the credit card marketplace very closely. So what I think I can contribute to this discussion is a response to the paper based on sort of a test drive of a couple of the credit card proposals in the paper to see how they might work. First, a little background on the market. Many of you follow it closely, but for those who don't, a couple of things to know. First, it does appear, one of the insights in the paper does really appear to be true based on research. I'm validating, Michael, I'm validating.
At least.
Well, there are actually many regarding the behavior of consumers in the marketplace with credit cards, in particular that they appear to overestimate the amount of debt that they might assume and underestimate their likelihood of getting in trouble. And that's especially important with credit cards because of the business model, because of competitive pressure and consumer demand and regulation. We have a business model now that has virtually no barrier to entry at the front end. You remember annual fees, don't you? Well, for most people, they've gone by the way of the horse and buggy. And people tend to shop based primarily on two things: the initial interest rate, if they think they're going to be someone who revolves debt, that is, doesn't pay it off every month like Alex's kids do, or rewards, if they're a so-called transactor, somebody who is likely to pay their bill in full every month. Back-end fees and interest rates are an inherent part of the marketplace now. It's easy to get a credit card. 75 to 80% of all households have them. Many have more than one. But if you run into any sort of trouble, and in some cases even if you don't, back-end so-called default interest rates because of a supposed problem with another creditor, a drop in your credit score, because of problems related to your payment behavior with the card issuer, paying late, going over limit, have become a very important part of the pricing model, as have fees, which the GAO and others have determined to have far exceeded the cost of living over the last, in terms of their growth over the last decade. So keep that in mind when we talk about some of these proposals. I want to focus on two, just so I can talk about them a little in depth. The first is what I think is a really good one, an opt-out payment plan for credit cards. The author suggests perhaps 5% of principal. The current situation is, depending on the issuer and the cardholder, 2 to 3%, just so you know. So it might be very helpful for a number of cardholders who are not experiencing economic difficulties, who have, in some cases, virtually no option but to pay at the minimum payment rate. We think defaults do help people as long as it's not particularly difficult. I think Michael might say you want to make it a little sticky, a little difficult, but as long as it's not really difficult to either pay more or pay less if you have no choice, then this proposal could deal with one of the big problems we've seen in the credit card marketplace. As minimum payments were lowered very significantly down to around 2% of principal, more and more people assumed unsustainable levels of debt, and the Consumer Federation of America thinks that that has contributed to the run-up in bankruptcies before the law took effect in 2005 and actually since as well. So a very positive proposal. Next, let's talk about the opt-out credit card, and this one I think is more of a mixed bag. Given the current business model that I explained, I personally worry about the tremendous regulatory pressure that would come from issuers to allow some of the questionable practices that are occurring in the marketplace. And by the way, the consensus among regulators, and I'm talking about the Federal Reserve now, which has offered a proposal for reform, and in Congress, is that disclosure alone in the credit card marketplace, not even good disclosure, is enough to combat some of these unfair and deceptive practices. And I worry about regulatory pressure by issuers on the regulatory agencies to either include in the standard or default credit card or the opt-out credit card some of these practices, which they would argue allow people to take, not stupid risks, but reasonable risks. And that's a very important line to try and figure out. For consumers, what's the difference between a stupid risk and a reasonable risk? And for regulators, what's the difference between a legitimate product that allows the company to recoup, on their financial risk, and a product that is unfair or deceptive? Very, very hard to figure out in many cases. So let me give you two examples of how this might work.
Can you make those last two examples?
Yeah. Michael mentioned allowing issuers to compete on rates. Well, as we talked about, they do compete on the initial rate because that's how consumers shop, but they also charge interest rates of 25 to 35% on the back end for people who run into any kind of problem. So one of the big questions that the Federal Reserve has pondered is it fair to suddenly and sharply increase somebody's interest rate, putting them in financial difficulty in some cases on their existing balance, not moving forward, because of, for example, a supposed problem with another creditor? It's a back-end interest rate increase. What would the default setting be? What would the standard setting be? Issuers would say, hey, we have to do this to reprice. We have to do this to recoup, based on our financial risk. You have to allow us to reprice in some fashion on existing balances. What the Federal Reserve has said is that there isn't genuine choice in the marketplace for consumers for a number of reasons. They don't have the opportunity to look around for another credit option that is, equally positive. Therefore, credit card companies shouldn't be allowed to reprice on existing balances unless the cardholder is truly showing serious financial risk, unless they're 30 days late or more. So I foresee some pressure on regulators to allow this type of practice, which is one of the most controversial practices in the marketplace, as part of the standard package, or to allow it to be marketed to folks who are wanting to assume a little more risk, who wouldn't get the standard offer. And it's pretty clear that from what you've heard about credit card disclosures, upfront disclosure, even very clear disclosure, wouldn't necessarily help consumers make an informed choice.
Thank you. Yeah, you probably know, I can't remember, but the Federal Reserve, in reviewing the credit card rules, actually did some field testing of different disclosures, and there's something that they have decided to ban because they could not, in their market test, find any disclosure that Americans could understand. So they just click.
Well, that's true. That had to do with the way they allocate payments that
Right,
you
if
make
you-
based on various interest rates.
Right, if you pay, your low interest bill gets paid faster than your other one, or the other way
Right.
around.
You get one of those teaser offers that Alex mentioned, and you run up a little debt on the card that you transfer that balance to, and your payment, you have no choice. The payment always goes to the debt at the lower interest rate. And what the Fed has said is that is deceptive, that they're actually offering a deal that is not as advantageous as they say it is, because you're paying more at a higher interest rate on any existing debt you run up. And they've tried doing positive disclosure. They've run it by their folks in people in focus groups and field tests, and people who don't know about this practice ahead of time can't figure it out, even with
Right.
good disclosure.
Mike, I want to ask one question of Michael and then throw it to the audience. This is sort of a public policy step-back question. So we had a period of time where it was the public policy of the United States to make credit, mortgage, credit cards, all of it, more widely available, often called the democratization of credit. And all the pressure was on the industry to lend to more people. The industry responded by saying, we'll lend to more people, but we're going to charge more because the risk is higher. Now we've been through a period where clearly a lot of lenders have gone out of business because they didn't get it right. And my gut is that it is not going to be easier for people to borrow 6 and 9 months from now than it is today. So if you go now and in the the Barney Frank, Chris Dodd, Obama, McCain, whatever reform, Financial Regulatory Act of 2008, which will be about 750 pages in the introduction and another 2,000 pages in the body, and you go start laying all these new scoring devices and new rules, isn't there a risk that you will be overdoing it, and instead of making it easier for people to make good decisions, you will make it harder for people to get credit than you would want otherwise?
Sure. I mean, I think we have a long tradition in our country of overshooting in lots of ways and then overcorrecting in lots of ways. We do that obviously in the marketplace. We do that with regulatory reform. We go through boom and bust cycles. It's not just us. I mean, you go back to the tulip craze in Holland, right? This is a pattern we go through where we engage in behaviors that are, by any measure at the time, should have been seen to have been excessive, and certainly after the fact, everybody agrees on were excessive. So I do think there's a danger of overregulation, and part of what we've been trying to do with this approach is to suggest we know that we went too far in one direction during at least the last decade, where we, as a society, paid insufficient attention to abuses in the marketplace. Can we develop tools that respond to those, that are market sensitive with respect to both borrowers and lenders, that can shut down the abuses but continue financial innovation? And so our understanding of that danger, as well as our understanding of human psychology, is what drove us to this set of proposals.
Okay, let's turn to questions. We need a mic? We'd have a mic? We don't have a mic? Let's try and keep them short, and remember that a question is something that ends with a question mark. And why don't you introduce yourself when you speak?
Yes, I'm Per Kurowski. I'm Voice and Noise Foundation. A mortgage, a $300,000 mortgage, 30 years at 11%. If that is made, if an investor thinks that is worth, should merit 6% interest rate, because perhaps a credit rating agency has so told him, then that mortgage becomes $510,000 of value. Between those $300,000 and $510,000, $210,000, is the really bubble, financial engineering bubble that we have been living. So in terms of behavioral regulation, don't we also have to look very well at the other side of the coin? Because we can really, if we work a little bit on both sides, we might get something more rational. For instance, instead of having that broker with his sign, well, we should perhaps just take away the credit rating agencies from the whole system.
So this paper is not designed to solve all of our current problems, and I do think there's a lot of room for changing the basic structure of our financial regulation, prudential supervision, capital requirements, transparency requirements, and the role of rating agencies is part of that, as is the role of credit default swaps, the supervision of broker-dealers, the supervision of non-bank lenders of a variety of kinds. So I don't want to suggest that we think all the answers are in this paper. We're going to need to address basically all the agency cost disruptions in the system, all the way up and down the chain, from the borrower all the way up to the investor. What this paper suggests is, even if we think we've fixed all that, the next financial innovation is going to come along and drive another wedge into it. So let's not base our borrower protections on the idea that we're going to drive agency costs to zero.
May I comment on that?
Please.
I thank you for bringing up the credit rating agencies, a topic on which I have done a lot of work. It's quite clear that in the current bubble and bust, the kind of behavioral decision-making on the investor side, relying on credit rating agency ratings, is part of the problem, which in turn was a bias greatly encouraged by the regulation from many governments requiring the use of credit rating agency ratings by investors. I think that's one good example on the other side of the market, on the investor side of the market, you can think about in this very context.
Sir?
Fred Berman of the National Academy of Sciences, National Academy of Public Administration. I'll direct this question to Michael Barr because he's worked in the federal executive branch. Have you thought about how to apply the insights of behavioral economics to the behavior and decision-making of financial regulators so that they are induced to recognize in a more timely way some looming risks and to take more proactive steps to deal with them? For example, recognizing the subsidy to Fannie and Freddie that was conveyed outside the budget by putting it inside the budget and requiring it to be annually appropriated might have changed the incentives for financial regulators.
I thought you were going to suggest clawbacks of their pay if things go wrong.
Or
Michael's look back.
joint several liabilities, some sort of pay-go scorecard for financial regulatory decisions that don't get made as well as those.
I'm just going to repeat the question for those who couldn't hear it. It's basically, can you apply the insights of behavioral economics to the behavior of the financial regulator? Is there some way you can change the scoring, both in the conventional Washington sense and in the sense of this paper?
Ellen might want to comment also.
Yeah. Thank you, Steve. No, I think you're right that that's a really important question. I think you more probably than anybody in the room know the relevance of the off-budget scoring of Fannie and Freddie for how the government, among other reasons, for how the government treated Fannie and Freddie essentially as a way of implementing government policy that appeared to be costless. So I do think that building transparency into the system can matter a lot. The prompt corrective action statute is put in place partly to increase scrutiny on regulators as well as on financial institutions. So you could develop similar kinds of models, whereas risk builds up in the system, there's increased light shine on regulators in response to increased risk. So I do think there's that idea. The other kind of idea is to build into the system protections that don't require additional policymaking decisions during times when policymakers have a hard time making those tough decisions. So, for example, if you build in counter-cyclical capital requirements, then it's easier for policymakers to act well by doing nothing. So as the economy is doing really well, if we had been building up our capital, our regulatorily required capital, because we had counter-cyclical capital requirements, say, we were chatting a little bit, Elle and I were chatting a little bit about this yesterday, you could have an asset-linked capital requirement. So as asset prices are going up, capital requirements go up instead of going down because we think that the assets are less risky because they seem to be more valuable. Instead, we decide that maybe we should link them to asset prices so we get more capital. You could do a similar thing, obviously, with the FDIC insurance fund and other mechanisms, so that our default rule is adjustment when things are good upwards. That would mean policymakers would not really have the discretion to make bad decisions.
I think it's naive to think that we are going to write rules that prevent policymakers from making bad decisions. And that Fannie and Freddie is a case not of not having the right rules, but of having a very conflicted sense of what the objectives were. And it seems to me the interesting counter case is the notion of an independent central bank, where in some countries the legislature has been extremely explicit about what the objective is. And it's the same thing with the budget rules. You know, the rules on spending caps worked as well as Congress decided they wanted to maintain them. And as soon as they found they didn't want to maintain them, they found a way around them, and then they went away. So I think that the rules are an important way of committing ourselves to the behavior we want to do, like telling yourself, in Eldar's example, I am going to go to the gym 3 times a week. But I think it's a mistake to think that that is the ultimate solution. Do you want to talk about the regulators? How do we make them have the right incentives?
Well, I think Michael's point is really extremely well taken, and actually we have a perfect example of a situation in which we did precisely the opposite, which was when the accounting profession decided to crack down on loan loss reserves and cause them to go down in the good times, and therefore when the bad times came, they weren't there. So I think that's a really good example. I do think the question of the incentives of 2 of the 4 banking agencies, and also the credit union administration, where they're funded off budget by the institutions that they regulate, I am not ready to say those incentives are all bad, but they certainly are conflicted and very different from the incentives that are applicable at the Fed and the FDIC, which are funded in other ways. And I think really thinking much more clearly about the funding stream will be a very important part of this next round.
Vivek?
I think the,
Say who you are.
excuse me, sorry about that. Maury Adet, I'm a local patent attorney. I want to say that the behavioral economic analysis is long overdue on this crisis. It would have been nice if somebody would have brought this to the forefront a little bit sooner, maybe 2002, 2003. But I commend your work on that. I would like to say that the Bullock one-page mortgage form combined with the Barr et al. Opt-out is a great combination that should be pressed to Congress. I think that is a nice, succinct, here's what everybody falls into unless you opt out. Here is the form, here are the set things that the regulators regulate. Very simple, very understandable, no matter what your language is, if you speak English or not, which we all know a lot of mortgages that went out the last few years were to people who didn't even speak the local language that well. 2 questions for Mr. Barr. Professor Barr, who came up with the opt-out, or was it an adaptation of, I believe you said it was Elizabeth Warren's opt-out on the credit card front, which she's been working on? And would the 30-year fix be the standard that people could then opt out on?
So Elizabeth's doing work on this idea of a clean credit card. And the opt-out idea, I don't know, who was the first person to use this expression, I don't know. But the idea of an opt-out home mortgage system, the 3 of us came up with, and the same with the credit card, but it builds on a long history of work in retirement savings. It builds on a lot of really important academic research that was done in the context of retirement savings, work by Madrian and Shea, Dick Thaler, and others. So it's got a long and important academic and intellectual history that well predates the 3 of us.
The world provided one of the first naturally occurring experiments when New Jersey and Pennsylvania introduced no-fault insurance in opposite defaults. And the population was highly comparable in many ways, and the difference in take-up was magnificent. And it was kind of the first occurrence that we observed, the impact of that.
Thank you. Was the 30-year, would the 30-year be the standard?
So you can imagine constructing different kinds of systems. So the easiest way to explain it is to say the standard is a 30-year fixed rate mortgage. But we talk about in the paper there can be a basket of opt-outs.
Thank you.
Travis, were you trying to get my attention? Did you want? Yes, sir.
Yes. Howard Katz. I'm currently at Elon University Law School, formerly with the Cuyahoga County Treasurer's Office. Just as a parenthetical, it seems to me that the rush to have the Fed do more regulation, years ago the Atomic Energy Commission both promoted nuclear power and regulated it, and I wonder if down the road we're going to see a similar flaw in the design. But my question is about payday lending, which is currently on the ballot in Ohio, regulation of payday lending, and is obviously a topic that you raised, at least indirectly. The argument with payday lending is that obviously the argument is that there's some utility to the borrowers. If you regulate it too much, it will push them to other systems, such as using their credit card, or to the banking system, but by definition they're not participants in the banking system. So how does your model address the issue of the optimal or the correct kind of regulation where you can be pushing people into other directions or into no direction at all?
I think that's just a great point and a great question. And one of the things that I have looked at in other work, I did some empirical work in the Detroit metro area on the usage patterns of low-income households in their among other things, in their credit practices. And you should be concerned about the potential for a substitution across products. So if you think you're solving anybody's credit issues by dealing with payday lending, you're wrong, because then they'll use an overdraft from a bank account, or they'll bounce a check, or they'll go hungry, or other things. You really do need to look really across the financial sector at the interaction. So one idea is to think about having a kind of disclosure process that would let you compare across products in the same way. So instead of seeing 24 jars of jam with different flavors, you would, because of the disclosure, see 6 jars of strawberry jam. So can we get to a process where someone could see that a payday loan is this, an overdraft is this, a credit card is this, and they all look the same? Because they're basically, they're different structures for offering expensive short-term credit. How do we figure out how to make them seem comparable?
Please. A state banking commissioner made the argument to me that consumers often prefer payday lenders to banks because the deal is much clearer, and they understand exactly what it is they're getting and exactly what it is they have to pay, and they like it better. Thinking about overdrafts, I also designed, at the request of Congresswoman Carolyn Maloney, a one-page overdraft disclosure form, which I'll be glad to discuss with anybody who's interested.
Can I add?
Yeah.
Well, let me mention one thing on payday and one thing on overdrafts. A good application of the opt-out principle, or in this case the opt-in principle, with overdraft would be Carolyn Maloney's legislation, which requires banks to get affirmative opt-in approval in advance from consumers to an overdraft loan, because in many cases there is not consent in advance for these loans, and that might prevent many of the abuses that we're seeing in the overdraft market. For paydays, the ultimate question is, what's the bias there? What's the psychological bias there that the lenders are aware of and using? And what we see is that they are exploiting the notion that a payday loan is often a one-shot event, where research from a number of the states where payday loans proliferate indicates that that's almost never the case. And I'm not sure how disclosure deals with that problem.
Ma'am?
Hi, I'm Michelle Martin. I'm with National Public Radio. I'm just curious about the ways in which cultural factors interplay with behavioral factors. It seems they're closely related. And the payday loan question is what sparked my thinking on this. Because I do a personal finance segment on my show, and it's been suggested to me one of the reasons that the payday loans are as prevalent as they are in some communities is that they go there. It's like, why are there so many drug dealers in these neighborhoods? Because they're recruiting in ways that Walmart is not. And that, payday loans are recruiting in these neighborhoods in ways that sort of conventional banks with better services are not. And I just wonder, like, for example, it was said to me, you go in there, there's somebody who looks like you, who makes you feel like they want you there, as opposed to you go to a bank where there's a guy with a jacket on who makes you feel like maybe you don't wear a jacket, you don't really feel like you belong there. And I just wondered if you've thought about the ways in which you use education to compensate for cultural preferences, which, predators are happy to exploit. You know what I mean?
So yes, I agree. Cultural factors have to play an enormous role. We actually have a paper on why non-for-profits don't do more marketing of the kind we're mentioning, where I come to your home with a balloon and a toy for your child, just like the subprime lender does, and try to get you to come to my business. I'm involved with community organization bases in Trenton, where we just sit there and look for people to show up. Nobody does any kind of marketing, which others do. So it's an enormous, and you're absolutely right. When I see people around me going somewhere and they know my mom and my sister goes there, I start going there too. And it goes back exactly to the fact that these places do so well is not yet an indication they're doing anybody much good. It's just a step that we cannot make without exploring it much more cleanly. I think that's by the way, education, I want to say something about education. We are educators, so I don't want us to give a bad name to education. I think that the answer to that is very simple. I mean, you need people to understand enough to have the right intention, and you need to educate them for that. The problem is that you cannot then say, now that they have the right intention, they'll take care of it. You then have to design a context that lets that intention translate into the right stuff. I'll give you the example I always give. You look at the USDA teaching the food pyramid to urban America, and then you go to where I go, Trenton, and you cannot find a fresh piece of vegetable within a 10-mile radius. So teaching doesn't help. Now, of course, if I didn't know that eating this way helps, I wouldn't do it. But now that I know it, unless you provide me with a context that makes it available, you haven't done anything. So I think that the education is a very clean piece. It's necessary, but it's not sufficient.
Michael, do you want to talk about alternatives to payday lending to Michelle's question?
Sure. Let me also say a little bit about locational decisions. So one of the other things that we discovered in this empirical project is the presence of higher concentrations of payday lending outlets in a neighborhood, controlling for other neighborhood characteristics, appeared to increase the payday borrowing. So there does appear to be something to your comment about if it's nearby, you'll use it. I should say that we didn't find any correlation with the presence or absence of bank branches influencing alternative use. So it was really the alternative location. In terms of alternatives to payday lending, banks ought to be able to offer an alternative to payday loan products. They currently do. Unfortunately, it's called the overdraft product, which is, as Travis suggested, under Federal Reserve regulations, not properly disclosed. That is to say, the Federal Reserve doesn't require proper disclosure of them. And also it can be extraordinarily expensive, and as my colleague Alex pointed out, is really complicated in any event as a structure. But banks could offer a simple product. They could offer a small value loan product. Sheila Bair at the FDIC has been trying to encourage banks to do that. I think she's right. Banks can get people to open an account at their institution, offer a 6-month self-amortizing small value loan product, get direct debit out of the account, so it's very low risk with direct deposit, and offer it at a very, very low interest rate because it requires very little human interaction and has very low risks. So I've been trying to encourage banks to do that. There are a couple other very large institutions that are experimenting with that now, and I think it really could make a difference to low-income families.
Alex?
If you read the congressional testimony in the 1930s leading to the credit union charter, you'll find that the biggest reason they wanted to charter these local mutuals was to let people escape, as they viewed it and phrased it, from the clutches of the local high-cost moneylenders. On the cultural issue, I think this is very important. Again, I'm picking up a little my theme with mutuals. The list of the, as they were then called, building and loan associations, these mutuals in Chicago in 1933, runs something like this. The Slovak Building and Loan, the Ukrainian Building and Loan, the General Sobieski Building and Loan, the Netherlands Building and Loan, the America with a K Building and Loan, and so on, for hundreds of them. I think this cultural point is very important. These, of course, Chicago is known as certainly historically, as this checkerboard of ethnic neighborhoods. But they put the local mutuals very much in accordance with the culture, language, and neighborhoods. I think it's quite a powerful idea.
Travis first, and then Elmer.
Yeah, on the point about culture, one of the debates that's been ongoing for a decade is, the issue of risk. I mean, did we see the marketing of these kinds of products because these communities were inherently more risky financially, or did we see the marketing because these lenders, I'm thinking of mortgage lenders here in particular, subprime mortgage lenders, saw a marketing opportunity that mainstream lenders didn't, offered a lousy product that mainstream lenders weren't offering an alternative to, and figured out how to talk to these communities and communicate with them and market to them in ways that were more effective. And I tend now to view it as the reasons being the latter, not the former, because there's a considerable amount of evidence in the mortgage market in particular that many folks in these communities could have qualified for better products, but simply were never offered the opportunity to take them.
Eldar?
Yeah, I'm just going to make a quick jump from culture to class. I think in America today, the main issue is class, not culture, I think. And this is what I do with paternalism. I want to say one word on paternalism. We argue about this.
For or against?
Well, I think discussing paternalism, I think it's like arguing about arguing about the weather in Chicago. I mean, we know there is weather in Chicago. It's just that I'm thinking about the sunny days and you're thinking about the rainy days. I think no anti-paternalist prefers that their pilot decide on her own whether she's tired or had enough to drink. No anti-paternalist wants their surgeon to decide whether she's qualified without being certified. I think we're anti-paternalist when we feel safe, and we're for it when we're feeling threatened. And that's a class issue. I've signed mortgage agreements that I could not understand and never read, but I was given them at the university and I trust them. You have all signed to use your word processor for Microsoft, which you couldn't understand and never read, and you're lucky enough to sign things that somebody's taking care of. And so I think that, to a large extent, the discussion of paternalism is where you are and how threatened you feel. And we're lucky, and some people need some serious help. And
The woman back there?
Yeah, Judy Kennedy, National Association of Affordable Housing Lenders, and Ellen and I have had this conversation a lot, Michael bit. I was violently opposed to what Michael was proposing months ago, and now I get it. And I get it not just because you're so clear about it, but because of the timeliness of it. And let's just, I don't want this to get lost in the discussion. I want to ask a question about how you're going to handle it. I remember in 2000 going on the Treasury, this was Clinton, Treasury HUD predatory lending task force around the country, and the poster child to me of the victim was the African-American woman in Philadelphia who was 70, who had worked at the U.S. Treasury Department, retired with a good income, had financed her first mortgage at 7%, a second mortgage for a roof at 9%, when she, the same year that we decided to convert from oil to gas, and we got a 3% loan from Wash Gas, and she called somebody from her church who refinanced her tiny little loans into $37,000 worth of indebtedness at 13%, and by the time she figured it out, it was too late. The cultural issue is one thing, but how did that guy get away with it? He got away with it because he could. And so back to, Michael, your point, Fannie and Freddie and regulation was a huge part of this problem. They weren't regulated. They were nurturing an alternative network of mortgage originators that financed about half of all the subprime loans from 04 to 06. How do we deal with this bifurcated situation where a bank under CRA has to pad the file if it makes a loan to value above your norm or a debt to income above your norm, which they're doing all the time and they're not defaulting, with this huge alternative network that has virtually no regulation?
So, just say a quick word. This goes directly back to David's point at the start of his moderator comments. I think we're going to see a fundamental rethinking of regulation in the next year. And to my mind, we have to have a system that has prudential supervision, capital requirements, transparency, and consumer protection that applies across the financial sector. And so we're not leaving borrowers to the whim of which particular regulated or unregulated or lightly regulated or differently regulated or blue, orange, or green lender that they have. We don't want that to determine what kind of protections there are in the marketplace, and I think that's got to change.
I think with that, we're going to bring it to a close since we're past 1 o'clock. I want to thank all four of the participants and you for such excellent work.